Good morning. It is Monday, August 17th. Here's what's on the agenda. Fed hike bets fade on soft US data. The dollar dips again and stocks edge up. The US prepares to unleash more economic pain on Iran. And copper nears record highs as supply tensions build.
OK, let's put some numbers on that. Let's talk about what we've got this Monday morning. Stocks 50 futures are a little bit higher this morning. Still feels like, though, we are in a sea of calm, as John Authers would put it right now. Copper's interesting. Actually, there isn't a shortage of kind of copper really out there. There's just a mismatch, particularly with the US sort of taking so much of current inventory. So copper is higher. We'll talk about that in the show. Big move higher in yields on Friday. We've kind of round tripped on yields over the last few sessions, and we're now sort of back to where we were kind of 3, 4, 5 sessions ago. So big move higher Friday. That sticks this morning. So the US 10-year, I'm just showing you this because we're not open yet here in Europe. We're kind of stable this morning, but at a more elevated level. Interesting things happening out there. The countdown to the opening trade starts right now.
So Guy Johnson there painting the picture of a slightly benign picture for equities. European equities last week ended a little softer. My focus is very much on what's happening with the dollar. The dollar is down 0.2%. So that is feeding into the modest risk-on appetite that we're starting to see. It's one of the catalysts. The retail sales data, Skylar, was obviously weaker than expected on Friday. You couple that with what's happening in the jobs data. You couple that with what's happening in inflation data. And you get the likes of Jan Hatzius, others as well, suggesting, look, you can push out expectations. You can push those further back in terms of the Fed is where the Fed will go. Interestingly, Jan Hatzius from Goldman Sachs saying he expects that actually the picture on inflation out of the US is more likely to improve going forward than deteriorate. Interesting, given that we still, of course, have the issues around Iran.
I mean, it's also interesting what you saw on Friday in terms of that was very weak data. It accumulates in the economic surprise index, dropping very dramatically over the past week or so. And yes, it's feeding into the dollar, but you still have this stickiness within yield. So yields in the US were up on the day, and that meant bad news for stocks was bad news.
So what is it that is keeping yields elevated at the moment? Because it does seem as if the economic data does look more benign. It does seem as if the inflationary threat doesn't look as big as we thought it was going to look even a few weeks ago. So what is it that's keeping yields where they are right now? Is it this argument around competition for capital? Is it something else? Is it the market just not believing and sensing maybe actually there is an inflationary threat, that the tails are fatter? I don't know. But I'm curious to see what ultimately proves to be the problem here in terms of why yields are doing what they're doing.
I mean, it's a combination of things, right? Yeah. And you see it hit certainly fiscally vulnerable economies more. So Japan's under a lot of trouble. It had weaker GDP numbers, which should be good for its bond market, but it came with a higher deflator. And so that inflation worry there, as well as the fiscal worries, are weighing. But you also look at like France, the UK, those bond markets are underperforming as well because of this worry around expanding deficits and inflation risk.
And in France, you've got political risk, of course, to factor in as well. So Japan is interesting. We had a former finance minister, former official in the finance ministry, and we've written this up, Bloomberg's been reporting on, suggesting that the BOJ needs to hike at every single meeting to get above 2%.
You think that's going to happen?
In order to close that gap. Well, you would need a significant change from Takaichi, arguably, wouldn't you, and the government in terms of how they're thinking about their conversation, their relationship with Governor Oana.
You've also got to get some economic growth going, and that's the main issue here. Is that you can hike rates, great, but the economic data maybe doesn't justify that, and that's the kind of the challenge that you keep coming up against with this argument that you need to raise rates in Japan.
And I mean, one of the biggest headwinds we have for Japan is the terms of trade shock. And we've not gotten any more clarity on that over the weekend. If anything, we've gotten escalation. So Lebanon has had strikes from Israel. That's the deadliest attack we've had since the June ceasefire. You've also had the MOU. That officially ends today between the U.S. and Iran. And we're waiting for these big economic sanctions from the U.S. and questioning what they will be. Will they target Iran's trading partners? Will they target banks? Will they bring in China, given China consumes something like 90% of Iran's oil? And does that open up a new trade front and a new worry for markets?
Did you read the piece in the Journal this morning, front page?
Wall Street Journal reporting on a very hardline approach being taken by the Iranian authorities. The IRGC has been re-empowered. They are working more closely with their proxies. They're building out their drone and missile capabilities. And they're girding for not just a longer conflict, but arguably a more intensified conflict with the US and with Israel. And this is the positioning right now of Tehran's leaders, military leaders and civilian leaders, again, according to this Wall Street Journal reporting.
It paints a fairly... I read that piece this morning, kind of first thing. It painted a pretty bleak picture as to where we're going in terms of the conflict in the Gulf. But at the moment, we're in this kind of scenario where we've effectively got the Strait of Hormuz closed, theoretically, but in reality, it's not. So kind of where are we going with this? Because at the moment, you've got this kind of transponder off, lights off kind of tactic being applied by a lot of tankers coming out of the Gulf. And it seems to be just enough to keep the world kind of ticking along at the moment. Now, there's a shortage of lots of things at the moment. You look at the chemicals industry, it's facing shortages. You look at what is happening. I read the piece over the weekend talking about motor fuel oil. I'm not talking about kind of petrol, gasoline. I'm talking about the stuff you actually kind of pour into the engine to keep it lubricated. That's a problem. So there's all kinds of issues here in terms of the challenges we're facing. But at the moment, just enough is getting out. But will the Iranians change that? And are there enough kind of supplies out there to balance it? Very hard to call. The
estimates right now between 4 to 9 million barrels per day getting through the Strait. 9 million is from the Energy Secretary in the US, which some have questioned. But other reports that between 4 and 9 million are getting through. But to your point, diesel prices and other components are still rising.
So let's talk about copper. Copper is up, but we've got enough of it. So why is copper up? Yeah. Copper's up because...
Do we have enough of it? The US has
the US has a lot of it. Okay, so we don't have enough of it. Basically, because of this threat around tariffs, all the copper's in America. So you've got this kind of weird sort of mismatch, which means that it's not ending up in the warehouse, the LME warehouses that it normally would. So you're getting these kind of weird price distortions at the moment. But we've probably got enough copper. But it just needs to reallocate in a slightly sort of better way. So this feels like it's a short-term market dynamic rather than a significant squeeze in terms of the availability of copper and a sort of supply shortage. Though it's interesting to see what the Chinese are doing because they're not in the way that they normally would, feeding into the market to balance things out.
I mean, what you're seeing in the short term, that is very much true in that you have a steeply backwardated curve. So that tells you that it's very much the front of the curve where supply issues are. But what I would say is we need to remember copper is one of these critical minerals that are needed for the AI revolution, and you're seeing increasingly kind of resource nationalism. So a couple of weeks ago, it was the Democratic Republic of Congo that did export restrictions that, did another leg higher in copper. So this is also something we need to watch for.
So the data out of China dropping, we think at around 8 a.m. UK time, we'll break that for you, of course, will be one of the indicators in terms of Chinese demand as they electrify increasingly, of course. We're going to get retail sales data, investment data, investment in China has just been on this downward slump. Retail has been fragile as well.
Except AI investment.
Well, again, we talk about the K-shaped economy in the US, and we have a slightly bifurcated economy in China as well, with the strength coming through, particularly not just less the software players and more the hardware players. And we're seeing some examples of that in terms of the listings that we're seeing. But yes, on the hardware front, some significant investments there around building out the AI infrastructure. So that is a demand for copper.
The I is doing okay relatively. The export story is doing relatively well, but kind of government spend and consumer in China looking very weak, continuing to look very weak. Shahriar Samath, StoneX rates head, is going to be joining us very soon. Helen Jewell will also be on the show a little bit later on, Fundamental Equities International CIO, just after 8. And Oana, Jinga, Dexory, we're going to be talking robots.
We are going to be focused on robotics.
You did a whole show
what
on
it does for logistics and what it means in terms of that competition from China as well. Because we're at a time when AI is allowing us up to the brain on top of the physical robot itself. So arguably, it's a pretty pivotal moment in robotics. So we'll get a view and a voice on that as well. Here's what else to think about throughout this week then. Later today, the ECB chief economist, Philip Blaine, will join a panel on Europe's defence build-up. Robotics, part of that story as well. Tuesday, Germany ZEW will break, giving us a clearer steer in terms of the health of that economy. Wednesday, we're going to get inflation data. This will be interesting out of the UK. Plus, of course, Fed minutes for the month of July. So any steer, any conversation there, any colour we get in terms of how the Fed is thinking about September. On Thursday, the Riksbank rates decision, and we will get earnings from Alibaba, Walmart, and on Friday, we got global flash PMIs as well. So some macro data to build out on top of some earnings stories as well.
That's not a lot. in terms of things that are going to change the narrative. I don't see anything in all of that is going to significantly change the narrative this week. We've got a 20-year auction coming up, haven't we, in the States? That's going to be interesting to watch.
Followed by a 20-year auction in Japan.
Followed by a 20-year auction in Japan. So I think those are going to be both interesting indicators as to kind of bond market sentiment. But it feels like it's a struggle this week to see anything that's going to significantly change the dynamic. Even Scott Bessent's kind of Iran sanction story, it feels like that's largely priced in, and it would have to go an awfully long way to significantly change the kind of trajectory we're on with the Iranian story.
And I mean, with the Fed minutes, what you have is a very divided Fed, so you care about this more, but also you've had so much data since then that's been on the dovish side. So can we really look to that minutes to get a clear direction of policy?
Okay. As the AI debt pile grows, we're going to talk about that. Alphabet awaits a debut offering of Australian dollar bonds. Do investors down under have the appetite? We will discuss that. Plus, the authorities battle to contain wildfires. There's a big one in Belgium, right next to the German border. Greece has seen significant wildfires over the weekend. Hot, dry weather continuing to wreak havoc across Europe. We'll have the latest on that story. Ben Grutterich, Markets Insight strategist at Invesco, up next. You want to talk to Ben? You want to talk to us? You want to join the conversation? IB Plus, BBTV Go is the function. This is Bloomberg.
Welcome back. Happy Monday. We are about 45 minutes away from the opening trade this Monday. European futures pointing high by 0.3%. US futures also pointing to gains. Nasdaq 100 futures currently up 0.5%. Let's turn to the latest out of the Gulf right now. The US plans to hit Iran with, quote, economic isolation, with an MOU between the two sides set to expire officially today, adding pressure to stalled talks between Washington and Tehran. Israel launching a fresh wave of strikes against Lebanon, which killed a total of 11 people, including a senior Hezbollah commander. Let's bring in Bloomberg's Abu Oba in Dubai for the latest. Let's start on the strikes in Lebanon then, Abi, and what that potentially could mean in terms of these US-Iran talks, if indeed there are talks, if only through other parties.
Good morning, Tom. Yeah, well, as you mentioned, these are the deadliest strikes against the southern part of Lebanon since that MOU was reached in June, which the expiry date for that, if you were to hold it into account, given the latest escalations we've seen in the region, mean anything. That deadline is due later today. We don't know what exactly is going to happen once it expires. Meanwhile, of course, the most important thing that we're monitoring right now, and the thing of substance, is that economic isolation plan that Scott Bessent has touted. And again, it's unclear just what exactly that entails, or if that will entail further sanctions against Iran. It's already one of the most, if not the most sanctioned country by the United States. Now, Iran sells 90% of its oil to China, so could this perhaps mean sanctioning Beijing, which would in turn lead us to a different story, further tariffs, retaliation by China on the United States? But again, unclarity around what exactly that means. And of course, the other deal that is taking place on the peripheral is that between Iran and Oman. It has been in final stages for the good part of 2 weeks. It remains in the final stages, and it will create some kind of shipping route. That is the latest we know in the Strait of Hormuz, to get that trickle of oil flowing back into it. We still are seeing attacks in the Strait of Hormuz. We're still seeing, for example, ADNOC flagged ships in the waterway getting attacked by Iran. Iran saying through one of its top military chiefs that the waterway is a God-given geopolitical asset for the Iranian nation, and that leverage will never return to its former state. So Iran continuing to assert dominance there. Are we back to square one is the question. We're not sure, but we're definitely not seeing progress in the wider negotiations, or in those negotiations that are taking place to reopen the Strait of Hormuz.
Abir, thank you very much indeed for the update. Abir Abu Omar joining us out of Dubai on the latest coming out of the Gulf. So we're going to get financial sanctions, but it feels like the Trump administration is pretty much parking the Iran situation until the midterms. Inflation looks largely under control. Financial conditions are really light, are really easy. Earnings look pretty good. Inflation broadly looks like it's under control. Sounds pretty positive, doesn't it? Ben Gutteridge, market insight strategist, joining us from Invesco now. Did I miss anything? Like, it all sounds pretty good.
I think you summed that up very nicely. Yeah, no, I think you're right to lay out the groundwork for this sort of benign conditions that we're feeling. There's certainly geopolitical risks, there are monetary policy risks, but with earnings impressing and broadening, with some of the more immediate inflationary concerns moderating, I think you have, and the labour market's not pointing to any really acceleration in sort of hiking agenda. I think you have that sort of Goldilocks flavour, resilient growth and stable monetary policy.
Any bears on the horizon?
Well, I mean, I think like the more immediate risks would be that if we got sort of a punchier, an upside surprise in inflation from the next print in the US, and either the Fed reacts to it with like a hiking cycle, or perhaps even worse, they don't react to it. And
so that's worse. It would be worse if the Fed didn't react. So that's why the long end might be a problem.
Yeah, I mean, I think it wouldn't be the base case, but yeah, an upside inflation surprise that the Federal Reserve was not seemingly alert to could see long bond yields sort of move higher. But I think, even though communication has reduced, what we are learning from the sort of the swing voters from the Federal Reserve is that if we see a core month-on-month print of like 0.3 rather than 0.2 or 0.3 or higher, that they would switch sides and move to a hike in September. So I think they're across that risk. But yeah, I mean, a Fed getting behind the curve would not be welcomed by the bond market or equity markets, I don't think.
But to be clear, the equity markets would welcome a Fed on pause in September.
Yes, but the ingredients need to be appropriate for that pause, which would be that inflation isn't running above target. They have this sort of like, I'm sure you're all across it, but like this sort of 0.2 number that if you annualise it, gets to about 2.5, and that for CPI, that's about target. They're comfortable with that, and the market, they wouldn't feel the need to hike, and the markets would be comfortable with them not hiking. But if inflation is further north than that, then perhaps the appropriate decision to take would be to deliver a hike, communicated with a cautious tone that we're not on of an aggressive hiking cycle, but the appropriate move might be then to hike. And and the markets may not like it, but I think they would deal with that better than like a Fed that's getting behind the curve by not hiking into a more troubling inflationary backdrop.
How constructive are you feeling on European equities right now, Ben?
Well, I'm feeling better about things in Europe. I mean, the latest sort of quarterly earnings were impressing, and not just from energy. That was broadening. It was, the financial sector, the banking sector doing particularly well. I mean, we've sort of seen these quarter-on-quarter earnings performance before, but it's normally on the back of like weakness, it's sort of a recovery from despair. But now we're sort of building on strength in Europe. Getting a succession of quarter-on-quarter impressive earnings growth is like quite a rare treat in Europe. So that's certainly encouraging. There are geopolitical risks, of course, not least on its from its sort of eastern flank. But no, I think the earnings story is encouraging in Europe.
Does that positivity mean you like European equities more than US equities?
That is a really good question, because it's sorry to be boring, but there's like benchmark issues, isn't there? There's like the US is a huge part of the benchmark, so we probably have more in US equities than Europe. In terms of relative calls, we are underweight US and overweight Europe. So on a relative basis, we think it's favourable to lean into European equities on this sort of broadening European recovery story and the valuation play. Plus, there is certainly some concerns about AI capex and being pushing too hard into the US.
I mean, when does that really become a problem for US equities? Are we at kind of peak earnings and that means capex goes down from here and that's worrying?
Well, I don't think we're probably at peak earnings. I think there's like a very healthy level of earnings growth expected, but that sort of second derivative, maybe we get disappointment on the scale of earnings growth. But like it just sort of the latest numbers that we've seen is that they're getting the return on this investment, and CapEx is accelerating. And I wouldn't expect, therefore, to see a moderation in that CapEx, but it's just the sustainability of continuing to impress with the earnings performance and the margins. Like the market is sort of predicting, we're at sort of peak margins, the market's sort of predicting that margins will expand further, and it's just sort of, it's quite hard to get on board with that. We're not too bearish, but the expectations, there's so much good news priced into that into that story. Sorry.
Is this is this as good as it gets? This is the question I'm hearing time and time again. How does it get better from here? You've got financial conditions epically loose. You've got a Fed that's probably going to stay on hold for the near term. Earnings look good, but can they be sustained? Can margins... where does the extra bit of good news come from that makes this market go further from here?
Well, I mean, I think you could have this sort of Jevons paradox thing where, you know, there is something of a price war in terms of the delivery of the cost of these models, which obviously for the large language models providers themselves, you know, Anthropic,
There's a lot of ifs
OpenAI.
and buts in there.
Well, yes, there is, but we are doing hypotheticals, aren't we? And if there is something of a price war in there, and that the adoption rates within AI are really impressing, and if that accelerates further, the volume could support the infrastructure plays, the chips and.
I don't think we're dealing with hypotheticals. We've got all this good news in that theoretically is not theoretically, that is in the price because we know it. That's known information. What is it that gets us? Is it like? Well, I mean, what is it that gets us to the next stage of this rally? What keeps the rally on track? Can earnings be sustained? What are we expecting? Analysts seem very bullish.
Well, remember that I was coming from the same position that you're coming from. We are sort of underweight US equities, and there is a level of caution in our view, and we are sceptical that we think we could well be near or at peak. Good news here, but the upside potential, I think, comes from a price war and even faster rates of adoption. But of course, not everyone wins in a price war, you know. And I think the large language models won't be able to charge so much for their even yet more advanced models. But that doesn't mean that there isn't, GPU rental rates don't keep going up, and that data centers keep being even more profitable. The cloud servers do wonderful things because volumes are moving higher. So you have to be sort of selective within that. On balance, as I say, we're sort of underweight because there's a lot of ifs and buts in there.
Right, love ifs and buts. Ben, nice to see you. Thank you very much indeed. Ben Gusridge, Invesco Markets Insights Strategist. What else do you need to know this Monday morning? President Trump has directed the Pentagon to substantially reduce joint military exercises with South Korea, while also praising the North Korean leader Kim Jong-un. In a post on Truth Social, Trump called the drills an inappropriate signal to North Korea, which he says is respectful towards the United States. The president indicated the decision was driven in part by frustration that the longtime US ally, South Korea we're talking about here, hadn't provided more support for his war in Iran. Water-bombing aircraft and farmers' tractors have joined forces to help firefighters tame Belgium's largest modern-day wildfire. The fast-moving blaze has forced hundreds of residents to evacuate near the German border. In Greece, 2 bodies were found close to an area where a fire broke out on an island near Athens. And the Financial Times is reporting that JP Morgan CEO Jamie Dimon has warned UK Chancellor John Healey against higher taxes on banks. According to the newspaper, a call between the two took place last week, and Dimon told Healey that higher taxes often drive away jobs, citing a decline in finance jobs in New York that he blamed in part on the city's tax burden. Healey has not yet publicly expressed a view on bank taxes. The budget is coming, though, so we await that with keen anticipation here in the UK.
Yep.
And everybody's looking at regulation. Are we going to see rollback in Europe in the same way we've seen in the United States?
Because it probably won't be to the same extent, right? But you've had a lot of positivity around financials in the UK and Europe and the US, and that could add to those tailwinds.
It's almost consensus, isn't it, when we speak to guests? A lot of favourable views on the European banking space. Maybe part of that is down to expectations that the regulatory environment will become a little bit more benign. But Jamie Dimon, of course, has been consistent on this. He had a close relationship with the former Chancellor, and clearly he's trying to make the case with the current Chancellor, who's only been in office a few weeks. There's a lot more coming up. Stay with us. This is Bloomberg.
Monday the 17th, good morning. 30 minutes to go until the start of equity trading, cash equity trading here in Europe. Let's check futures, see what they're telling us right now. At the moment, not very much. 0.03% to the upside is basically what you are seeing. In the States, Nasdaq minis are up by 0.5%. S&P's up by 0.2%. The action, though, Friday was definitely in the bond market.
Let's check in on the bond market right now. Interestingly, Treasuries seeing a very modest bid, yields down about 1 basis point across the curve. Here's the European picture right now, largely unchanged on Bunds at 320. Yields up just 1 basis point on OATs on France, just about 4% right now, and 398 on BTPs, also largely unchanged so far in the session. Let's get a deeper dive right now on the fixed income markets and bring in Shreya Samarath, who is EMEA head of rates at StoneX. Shreya, good morning. Thank you for joining us. Let's start on the US then, because we had weaker retail sales. You put that together with what's happening, inflation and jobs data, and there is a view building now that September is looking increasingly unlikely for a rate hike from the Fed. Is this a Fed that is now on pause for the rest of this year?
I think it's difficult to tell because the OIS curve has been fluctuating wildly. But last week's data was really interesting. U.S. CPI, PPI, and retail sales collectively wrote off that December rate hike for the first time since May. So that's really significant. But interestingly enough, while the 2-year led that rally, there was retracement in the New York session. So that tells me we're not trading just data anymore. We're trading Fed credibility and geopolitical risk.
OK, on the credibility, what is the key issue right now, and how does the Fed chair try to articulate around that and communicate around that?
I think having flexible rhetoric would certainly help instead of going very hawkish and then having to dial that back. But I think data quality is an issue worth looking at as well. And Kevin Warsh has spoken to that. The NFP is an excellent example of the contraction not being the problem, but the trends behind it. Since 2021, about 33% of NFP prints have come with large revisions over 100K, and a lot of those with a negative skew. Also, we're seeing survey responses decline from 60% to 45%. This is exactly why Kevin Warsh is saying don't fixate on a singular data print. He needs to now work with task forces to improve data quality. Otherwise, you're running into the risk of moving out of the shadows of forward guidance, but into data darkness.
So the Fed is clearly a risk to the long end, but also fiscals definitely had an impact there. Is there anything Scott Bessent can do to contain those yields?
Yeah, that's a great question. I think it's really interesting what he's done is he's actually taken a page from the playbooks of both Janet Yellen during the pandemic and also Destiny's Child, bills, bills, bills. He's responsible for $827 billion of net Treasury bill issuance. That's more than double the 2025 slate. Now, right now, the money markets are lapping this up, but there is a trend here. The 3-year U.S. Treasury auction had solid demand, but the 10-year and the 30-year last week both had tails, with some of the highest yields since the 2000s. So perhaps the front end is the sweet spot for now.
I mean, can you really issue more? Is the 20% really a limit, or is it just more of a worry that means you have a problem down the line? If you have to have Fed hikes, your borrowing costs rise so much more quickly when you have issuance at the front end.
Yeah, I mean, generally we do have a historic high in debt to GDP ratio, and that 20% has been breached before, such as during the pandemic. But this will all change if the money markets stop showing interest in this trade. And we did see a little bit of tepid demand in last week's bill auctions. But generally, this is a tried and tested strategy. It makes sense for governments to have flexible funding and also go for cheaper borrowing when there's a long end reckoning going on.
Are we overly focused on the Fed right now? Should we be thinking about other central banks? I appreciate that the Fed's a fairly big gorilla in the room, but collectively, are all the other central banks actually where we should be focusing our attention, where rates are likely to go higher in aggregate amongst that group? The Fed may do nothing, but other central banks around the world may tighten. Which one should I be spending more time thinking about?
I'm thinking about all of them collectively, because restrictive rates doesn't necessarily mean a hike right now. I think yields are elevated to account for a protection mechanism against all of the uncertainty. Look, for the last 6 months, we've all been trading oil, all of us, globally. Yep. And interestingly enough, the bond markets are now starting to recalibrate toward what each of them cares about individually. So in the U.S., yes, that's Fed credibility. But in the U.K., the gilt markets tend to trade off of borrowing costs. So that's what the Bank of England will be thinking about, and also ahead of a new chancellor and an autumn budget. Meanwhile, in the EU, you've got that constant risk of an over-reliance on oil. And, of course, you've got idiosyncrasies with political risk like French elections. So overall, central banks just need flexibility right now to deal with the situation. And unfortunately, that's coming at the cost of higher yields.
We've got higher yields, but I'm looking at financial conditions being incredibly loose. Particularly, like in the States, they're incredibly loose. Walsh talked about this initially. He talked about this idea that we have policy being too accommodative for Wall Street but too tight for Main Street. Are we seeing evidence of that beginning to emerge? And which one of those two do you think he's going to focus on? Because you look at the retail sales data, you look at UMIS, you look at all this data at the moment. It's telling us that the Main Street's suffering. Wall Street looks great. Do you think he's going to have a problem with that?
It's a difficult balance for sure, and it reminds me a little bit of the 1990s dot-com boom with jobless growth. And we see similar in the latest labor data in July, right? We had a lower unemployment rate, but a lot of that was because we had a 1976 low of labor force participation and a stable quits ratio. What that tells me is that maybe, especially with AI automating jobs, we might get a successful economy defined by a lower employment trajectory. And that might necessitate higher yields, especially with real wages stagnant at 0.1% year on year. You've got fewer dollars being earned, more scrutiny on those dollars being spent. So even if it's a good thing, still leads to that elevated yield environment.
You touched on the UK. What is more important for gilts? Is it the energy market? Is it energy prices? Or is it the budget?
It's probably going to be the budget when that time comes up, but I will say that energy prices and that over-reliance on oil is always going to be in the backdrop, and that's something that will affect the belly in the long end. The budget could see fluctuations there as well, depending on what happens with taxes, with income, with revenue. But the combination of those two tends to affect the UK. Generally, I would say the budget if we weren't in this geopolitical situation, but the UK is also heavily reliant on oil imports.
We now have a Bank of Japan hike pretty much priced for October, something like 20 basis points for September. How do you get the conditions for multiple hikes? Is that even really a possibility?
I think the Bank of Japan situation is a growth challenge, but interestingly enough, with that yen intervention story, I'm looking at the cross-currency dynamics as well. Interest rates and FX interacting together, and perhaps that cross-currency basis trade. On the interest rate leg, if you're thinking about Japan, who is the largest foreign holder of U.S. Treasuries are really tempting with elevated yields right now, with the 30-year hitting 19-year historic highs. And on the FX side, the dollar's been pretty resilient still, despite credibility concerns and that historic debt-to-GDP ratio. So the combination of those two things means that the Bank of Japan still has, a negative inflation-adjusted rate. It's a difficult trade.
How are traders, how are investors positioned around the politics of France? Again, you tied in how you expect central banks to have to react to the idiosyncrasies of their own jurisdictions. French politics very much in focus, particularly as we lead up to 2027. Should we brace for an aggressive sell-off in French debt?
That's what the markets have been hinting at, but that doesn't necessarily mean the election will play out that way. There's still time to go. Since April, the French government has a lot to deal with having a really high budget deficit. The OAT Bund spread is blowing out to highs again. I think it's going to be a balancing act between getting that deficit under control but still stimulating growth. They could take a similar route to Germany, which is spending heavily, but of course that comes with other risks as well.
Shiria, great to see you. Thanks for stopping by to see us. We really appreciate it. Shiria Samath, EMEA rate strategy head at StoneX. Coming up, Alphabet looks to debut an Australian dollar bond as it goes global in the hunt for AI funding. How much demand is there down under? We'll talk about it next. This is Bloomberg. Welcome back. 42 minutes past the hour. It is Monday the 17th. I needed to check the date just to figure out exactly where we are. In terms of where we are with markets this morning, a little drift higher. Drifting higher seems to be the narrative at the moment. Take a look at the NASDAQ over the last few sessions. We're kind of gently drifting up. A little bit of a dip on Friday, but this morning we're drifting back higher again. Kind of August drifting, kind of gently moving higher. Everything's very consensus and nice at the moment. Everybody's very happy.
Skylar's a bit worried about the consensus. Are you worried about the consensus on these markets?
I think maybe the thing I'm most worried about is growth. The UK is a key example where growth was quite strong in the first half of the year, but there's a seasonality in the data. Yep. You're more worried about inflation data that comes on Wednesday. Maybe you get a 3% rate or a higher core services print that makes you concerned about Bank of England rate hikes.
OK, let's get to what's happening in terms of tech and particularly the funding around the hyperscalers, because Alphabet has hired banks for what would be a debut offering of Australian dollar bonds. It's just one of the US tech firms flooding credit markets, of course, with debt in order to fund investments in AI. That has its own growth impetus, of course. Bloomberg's Anthony Stevens has the details. Anthony, is this a sign of desperation from Alphabet or a smart way to tap a market for additional liquidity to fund that infrastructure build?
Yeah, given the kind of tightness of credit markets, you'd have to go with the latter, right? They've been able to raise money relatively cheap up and down the capital structure. And, bear in mind that they do have those bonds in the UK as well. US IG credit is extremely tight. Their CDS is extremely under control. They are cashed up. So in terms of accessing debt markets here as opposed to equity markets, it's probably a decent idea. This is in the context of them making progress on monetizing AI here. So Alphabet, has this vertical around custom chips that is new now, and that goes in line with the existing kind of USP around search and monetizing AI and search. So there's a lot of moving parts here on Alphabet. And also remember, Alphabet's made a ton of money in SpaceX, right? That came out on 13F filings. That is going to be a gigantic addition to their kind of war chest now that can be added into financial modeling now that we know for sure how much money they made. So in terms of a credit positioning, in terms of their cash flow and kind of balance sheet, they're in a very strong position. And as a result, they can raise money quite easily from the credit markets.
Let's talk about Anthropic. Top line looks pretty good. Again, these companies are getting ready to IPO. The top line, is that the right metric, Anthony, to be looking at in terms of how we should value Anthropic?
Well, look, it's the right metric to use because we don't have any real valuation metrics for this space yet, right? And you're seeing that in the Chinese listed LLM space, which is much smaller than Anthropic, yes. But you can see the kind of volatility in the Chinese space as they come up with these new models. The valuation kind of dynamic for these companies is not set in stone. That being said, the revenue growth is really remarkable, right? It's a multiplier of last quarter and several times what it was last year. So in terms of setting up that flywheel to be listed, the fact that they're positive operational income, that they have multiple more $1 million plus paying customers, that a reasonable amount of that growth is coming from agentic AI, which is the new vertical obviously that everyone's talking about. Those are pretty positive indicators into the IPO, and that is what is causing a lot of the bullishness in tech today. Under the hood in Asia, we're seeing a very strong performance from the picks and shovels trade in Japan and in Taiwan.
Alibaba's been up something like 2.5% on selling of its gaming arm, as well as claims over its use of its AI model. What do you see ahead for the company?
Yeah, it's an important earnings week for China AI, right? So you have Baidu, which is, they got off to a very early start in AI, but now they've been left behind. And it remains to be seen how much they can continue to play for. And then Alibaba later in the week. So Alibaba is going to be very interesting because they are suffering from this downturn in the China consumer, but they're making a lot more money on their cloud side. And how much money are they making from this LLM push that they're recently starting to dominate in? So the headline that you alluded to is that Alibaba's models are the most downloaded open weight models in the world. So that is going to be very interesting. Are they getting any money out of that? Or is it simply driving adoption of China's way of doing AI across the world? So that is going to be one data point. But for now, the Hong Kong-China tech ecosystem is taking kind of joy from the fact that they are getting downloaded so much. And you're seeing a big push higher in the hardware space in both the Chinext and in Hong Kong. And that seems to be the place where investors are deciding the water is much clearer. Buy hardware and let the software titans duke it out.
Okay, going to keep watching that trade. Anthony, thanks for the update. Really appreciate it. A lot going on. Anthony Stevens joining us on the tech trade. Let's talk about what's happening with the dollar trade. Paul Dobson, Bloomberg Asia Markets Executive Editor, joining us now for 3 minutes. The data are pointing the dollar lower. Is that the right kind of way of looking at things? Retail sales was weak. UMISH wasn't great. You've got an inflation pitch which is getting better. All of that points down for the dollar. Is that the right trade, Paul?
It feels like things ain't looking great for the dollar right now, Guy. And I think, like you said, part of that is definitely the soft patch that we're going through in terms of the data for all that the earnings that we've had from the companies have been incredibly strong. It's causing people to have doubts over how fast and how far the Fed might hike, whether it will hike at all. And so that's putting pressure on the dollar. At the same time, the market is pricing more action for central banks all around the rest of the world. So that's making the rest of the world's currencies look a little bit more appealing weakening relative to the dollar too. So you've got the US currencies the weakest since May, and you've got emerging markets having a particularly good time of it at the moment. On a sort of total return basis, they've risen all the way through the summer, something like 7 weeks in a row, and still going today as well. We're seeing a turnaround in Asian currencies, perhaps helped by the US joining the Japanese intervention. The yen is probably the standout one that isn't moving while everything else is. That's sort of staying pegged close to that 159 level at the dollar against the dollar at the moment.
I mean, you've had pricing come out for the Fed in terms of not as much hawkishness, but yields across the curve in the US are still trending upwards. Is there worry of how high could you really get there?
I definitely think that the market is also worried about the bond market, and I think what's significant is how that's feeding into a weaker dollar rather than a stronger dollar. So rather than getting the benefits of higher interest rates, you're getting those misgivings playing out in both the FX and the rates markets at the same time. People are keeping particularly close eye on the back end of the yield curve, of course, where rates are setting those new highs above 5% on a more or less weekly basis at the moment. That's where those real concerns are starting to play out at the moment. And it's not just about the path for the Fed, it's about the outlook for inflation, it's about the supply that's coming into the market, both from the government side of things, with the Trump administration doing little to correct that, but also in terms of the issuance that we're getting from the corporate space, particularly funding the AI data center build out.
Yeah, and you talk about the issuance on the government side. So we have the 20-year bond issuance later this week. We've got, of course, FOMC minutes for the month of July coming through on Wednesday. What for you is one of the key market drivers to look ahead to this week, Paul?
Yeah, Tom. Well, actually, and if you read John Authers, he talks about this as pretty calm waters this week. There isn't a great deal to watch out for, and I think that that's possibly a bit of a problem in that it speaks to that kind of continuing trend of what we've already seen. So we do get Fed minutes. Will they tell us anything particularly new? I'm not so sure, which means that, the dollar can continue to weaken, the bond yields can continue to rise. And I think what will be interesting to see is whether that means that ultimately it starts to put a brake on the gains that we've seen in the equity space recently, or whether they can continue their own momentum from the earnings. I think we get the consumer staples companies reporting this week, so that will be one thing to keep an eye out for.
OK, Paul Dobson, Bloomberg's Asia Markets Executive Editor. Paul, thank you. Let's get your stocks to watch this Monday now. Alex Morgan is standing by. Alex.
Morning, Tom. Well, we don't use the Q word in news, so I'll say it's a less noisy week on the corporate front when it comes to stocks. But let's kick off with copper. It's been a bright start to the week for copper. I mean, it's approaching a record high here in London, so you want to keep an eye on the miners this morning. Antofagasta, KGHM Polska, as well as Atalaya mining copper. We're seeing there a lot of the metal flowing towards the United States, the uncertainty around a tariff decision, seeing other markets scrambling for supply. So expecting to see a lift then in the miners this morning as the copper price, which is up almost 16% this year, keeps seeing that lift. BHP as well, interesting here, primarily listed in Australia. They do have a London listing, though. They too could also have a lift. UK banks, we're looking at them this morning because of a report in the Financial Times that Jamie Dimon had a call with the new UK Chancellor John Healey, warning against taxes on banks. You can see why that's a live issue over here under the new administration of Andy Burnham, pre their first budget. They're weighing whether or not there could be a tax levied to, say, support households with energy bills. And you're seeing here across the big names in the UK, the big banking names, you're seeing a really bumper year. That is a live political issue. The FT reporting that Dimon warning Healey, the new Chancellor, against going there for fear of driving jobs away. So keep an eye on the banks this morning. And finally, let's finish with turbochargers. The Acceleron, they make turbochargers for engines, for everything from ships to across the board. You can see year to date up around 14%. They've been upgraded to buy from hold at Berenberg. Analysts saying that the growth cycle looking very positive, marine driving that, but also the energy sector giving a big boost to Acceleron, the turbocharge maker. Some of the names we're keeping an eye on, but those copper miners probably going to be top of our list this morning. OK, turbochargers and copper miners. Alex Morgan, thank you very much indeed for some of the stocks that could be on the move on the open, at the open, of course. European futures right now pointing higher by 0.3%. What could be the next turbocharger, do you think, for these markets, Skylar?
I mean, I think you need to start thinking about easing again, because that's the way market flips, right? As soon as you price out hikes and you go towards a pause, you're looking at easing. And even when you have hikes 2 years out, you have easing. And so, maybe that's the next catalyst. I don't think it necessarily comes soon, but...
Why would they ease? I'm assuming we're talking about the Fed here.
Yeah, I mean...
Or maybe even the ECB. Maybe the macro data, we're going to get PMIs later this week, tell us that may be the next thing.
Well, the clearest case is probably the Bank of England in terms of they are the ones who really have restrictive policy. But you can't really take out that easing, or put in easing rather, until you have the US-Iran situation resolved, because oil prices could shock higher at any point.
No, we just have a reminder today of how far away we are from that prospect in terms of any deal between Iran and the US.
But there's also but there's so many other inflationary factors out there at the moment. You've got the weather. Central banks need to be weather forecasters now as well. There's a story on the terminal this morning talking about chipflation washing ashore here in the UK. Supply chain shortages, bottlenecks everywhere. You were writing about this on Friday. Is it just Iran, or there seem to be so many other things?
I mean, yeah, absolutely. And the worry is that eventually gets you to demand destruction, which is, easing possibility, but not great for equities.
Dollar down right now, about 0.2%, so that's a catalyst for parts of these markets. Is that purely tied to expectations around Fed and pushing out those rate hike bets? I mean, this is certainly supportive for EM.
Yeah, I mean, economic surprises, I think, quite a lot there in terms of the differential is very much not in favour of the US.
Scarlett's off, back to the day job. She'll be back to, I think she's here for 2 hours tomorrow, though. Looking forward to that. OK, futures are pointing a little higher this morning. Market open next. This is Bloomberg. Monday morning, good morning. Couple of minutes to go till we start equity trading here in Europe, cash equity trading. Let's talk about the legacy from Friday, and then we'll talk about the futures picture. This was the S&P session Friday. We drop early, we go sideways. There was a lot happening in the United States Friday, but not a lot of it was coming in the equity space. You saw some fairly big moves in the bond market. You got the UMISH data. You got the retail sales data, neither of which painted a particularly let's call it hawkish picture. Both fairly dovish prints, and that obviously fed through into our thinking around what is going on with the Fed. So that's the legacy out of Friday. This morning, Nasdaq futures are actually up. So if you take a look at a slightly longer-term futures chart for the Nasdaq, gently drifting higher. And this morning we drift higher a little bit as well in Europe. Stoxx 50 futures are up by 0.3%. FTSE's up by 0.4%. DAX futures up by 0.2%. So we continue basically this little incremental move to the upside. There's not a lot going on at the moment. There's some very consensus trades on at the moment. The market feels quite calm at the moment. Volatility's low. All of that's just gently nudging us to the upside, Tom.
And before the break, you were talking about price pressures coming through from things like copper. And we're at copper near record highs, 14,370. So watching for your stocks to watch, the miners on the back of higher prices around copper, when there's a benefit there. UK banks in focus. Jamie Dimon, apparently, according to reports, has been putting some pressure, it seems, on the UK Chancellor not to raise additional levies on UK banks. We'll see if there's any banking reaction to that. AstraZeneca, this is around a story that a cancer drug trial has been paused or stopped. Success is seen as unlikely. We'll see if there's a broader read across AstraZeneca and other health makers. Guy.
OK, here we go. Let's talk about the Monday session. Let's give you some numbers. Let's show you where we are opening. We're expecting a little tick higher. Not much, just a little tick, but some positivity may be coming through once again for these markets. Equity markets, 0.1% expected out of the FTSE, maybe 0.3 actually, as I just showed you on the futures picture, but we're nearly there. There you go, 0.2%. You've got the Stoxx 600 not doing much at the moment. I'm slightly concerned about what that little white box is for the DAX, but we'll come to the DAX a little bit later. It doesn't usually open at this point. CAC's expected to be open 0.2%, but actually opens in negative territory. IBEX is down as well by 0.2%. The AEX is fairly flat. Not a lot to see here. So at an index level, not a lot happening, but just gently, just drifting to the upside, Tom.
Yeah, let's check in on how the individual sectors are reacting. And we're flagging what's happening, of course, in terms of the miners, with copper prices. We're going to get to the China data shortly. In terms of your sectors, then, in an environment where we continue to grind higher, as Guy was saying, top of the list then is basic resources. The miners are getting a lift from higher copper prices. That sector is currently up 1.5%. Tech is also gaining 0.7%. Industrial metals up 0.4%. On the downside, you've got personal goods, personal care, you've got food and beverage, you've got media. So personal care, drugs, that is currently down 0.9%. We had the news around AstraZeneca stopping a trial around a cancer drug. Some of the individual movers as well in focus, Guy.
I'm trying to get the CAC to load up so I can see exactly what is going on there. Slightly weaker than maybe anticipated. We're talking about fine margins here. There's not a lot really kind of happening in terms of the story. But you do have some of the luxury names on the downside this morning. So LVMH is a bit softer. Hermes is a bit softer. Kering's a bit softer. In terms of the weight to the downside, L'Oreal is probably the biggest weight to the downside on the CAC Carrot. So luxury's a little softer, but the tech names are looking pretty good.
Yeah.
Schneider's up. ST Micro's up quite nicely.
Let's get to the China data right now then. Real weakness when it comes to the retail sales picture once again. So the China data dropping right now. It's a deluge of data, including industrial production and retail sales. Let's start on retail sales then. Year on year, you're seeing an expansion of just 0.6%. 0.6%. The survey had been for an increase of 1.5%. This is for the month of July, year on year. In terms of industrial production data, you're seeing a pickup there of 4.5%, but that is below, again, the survey and below the previous month. So industrial production increasing year on year by 4.5%. Fixed asset investment, you're seeing a contraction once again. This has been a long-running issue now. A contraction once again in terms of fixed asset investment, contracting 6.7%. So it's a deeper contraction again than had been expected in far deeper contraction than the previous month. So that is looking pretty bleak for China. And again, the consumer retail sales suggesting the consumer remains very, very cautious over in China with retail, with, of course, house prices continuing to contract. And that has that direct read across to consumer in China.
If you think about the kind of engines of Chinese growth, very few of them are operating at the moment. The consumer looks weak. Investment's kind of mixed. Industrial investment fairly weak, but AI investment actually okay. So that one kind of balances itself out. The government not spending anything like as much as it has done in kind of previous cycles at this point. Exports continue. Right at the end of that kind of AD story. That's the only thing that seems to be working in China at the moment, and that's being pushed back. Everybody else is trying to push back that quite hard, but. It is. You've only got to look around the world and see what is happening to see the strength of that export demand right now.
And a lot of that export is around the hardware story that ties into the spending around AI. Let's get a broader take on this and the details and bring in Rebecca Chin-Wilkins, standing by in Singapore, someone who's had a finger on the pulse, of course, of this data and the China story for a long time. What for you then, Rebecca, are the key takeaways from this data?
I mean, to some extent, I think you and Guy really touched on the two essential points. Now, two big things, those retail numbers, which of course have come in pretty soft, and the domestic demand question has been such an issue. We think back to May, and we saw the weakest number for the first time sort of dipping in that way since the pandemic, and it has then been pretty lackluster since then. It has been such a difficult problem for policymakers to solve, and of course has been accentuated in some ways when we look at, to Guy's point, some of that better success coming from the AI story and that super cycle boom that has helped kind of balance things out, as Guy pointed out. The other number to look at, I think, is, of course, industrial production. Now, we were expecting some of that weakness to come through. We have had really extreme weather events in China, the likes of which we haven't seen in a really long time, decades. So you think about typhoons, rainfall and so on, and that halted production in factories. It disrupted trade happening in ports. So taking those two things together, starting to think about this question of whether or not we see stimulus coming through. The other number that I would just point out that's quite puzzling is that that investment figure. I mean, quite interesting to see it coming quite so low there.
Rebecca, are the authorities comfortable with this mix? Are they comfortable with the current trajectory?
It's a really good.
Clearly, obviously, you've got a lot of consumer
weakness,
but
they don't seem that
bothered to do anything.
Yeah, I think that's absolutely the question that investors will be asking when they're looking at this set of numbers. We are now going off into the second half of the year with a relatively weak outlook, having already, for example, kind of undershot that growth target. Now, what we heard from policymakers
in recent weeks is kind of a slightly more positive tone and maybe offering more support, but always stopping short of actually seeing stimulus. I think that question deepens and becomes certainly more urgent now, but we've also seen that Beijing has had this sort of tolerance for pain and in some ways happy to rely on that positive story in the AI space to try and offset some of the weakness we're seeing elsewhere. I think if we do see any kind of policy support, the fall is typically when we see those type of announcements and those kind of pronouncements coming through. And the other big question as we enter into that period will also be a really acute attention being paid as to the backdrop of China's sort of economic backdrop as President Xi thinks about heading into those bilateral meetings with President Trump and the whole US-China relationship too.
Rebecca, thanks for the update. Appreciate it. Instant analysis on the data we are getting out of China right now. Rebecca Chung-Wilkins joining us from Singapore. Let's broaden the conversation. Helen Jewell, Fundamental Equities International CIO, joining us from BlackRock. Good morning.
Good morning, Guy.
The world looks okay right now, doesn't it?
It does. It does look okay. And even when you're seeing some of those numbers coming through from China that, are perhaps on the softer side, there's still some really interesting active opportunities within China. So I think there is a lot to be excited about right now. Everything does look okay.
How long? Goldilocks is in charge. Mm-hmm. Are the bears waiting in the wings? Are the tails there? We're in the sides, in the middle of all this. We can kind of sit back and chill and think about what's going on. But as we come back, do we need to think more about where the risks lie? What happens with bond yields? What happens in terms of some of this inflation story, which seems to be still coming towards us? How are you thinking about how we kind of enter this kind of end phase for the year?
So I'm not sure that it's Goldilocks in charge. But what is definitely in charge at the moment is the earnings. The earnings are the key number that is really driving so much of the market at the moment. A lot of questions I get are we in some kind of bubble? I don't think we are in a valuation bubble by any stretch, but the earnings are propping up a lot of the market. And even when you think about the inflation side and the potential impact from interest rates, that the market seems to be okay with that because so much is coming from the earnings and the strength in earnings that we continue to see. So that continues to be the key driver of the markets. Now, where things like inflation and therefore interest rates will be important, and of course we have seen a kind of reduction in the expectations of interest rate hikes, but they're still kind of running at 30-40% levels of assumption of some kind of hike, is the shape of the market and the kind of stocks that are performing well and less well. So from a selectivity perspective, I think that's where those kind of issues come into play. But from an overall direction of the market, it is the earnings that remain absolutely key. And everything we're hearing through this earnings season is actually remarkably strong, globally remarkably strong as well, Guy. Remarkably strong. I mean, I must admit, I didn't anticipate necessarily that Europe would be as strong as it was. I think I've been on this show talking about maybe high single digit. It was double digit growth, 22%, about 14% if you exclude the energy companies. I mean, I don't think any of us maybe would have expected quite as good an earnings season, one of the best for I think 3 years that we saw earnings in Europe this year. So really supported by an earnings story. So I think that is what is key at the moment.
What is the extent of dependency for those earnings on the CapEx, the AI CapEx story?
Well, this is what's interesting, Tom, about Europe, is actually it's not that dependent in Europe. In other parts and other regions, yes, it is. And in particular in the US, we see a really high correlation, of course, with the AI trade and therefore the need to see that spending continue. But outside of that, for example, in Europe, I mean, you've been talking about it this morning, the European banks are actually a really key part of that. So, don't get me wrong, the AI trade is still the key driver of the markets. But actually, from a regional perspective, you can get some really interesting diversification in Europe. Now, the correlation isn't zero. I don't want you to think that I'm saying that's an entire diversification trade. But it certainly gives you a way to have less exposure than other regions do.
Just some additional detail on that AI CapEx spending story. Alphabet then, this is redhead across the terminal. Alphabet aiming to raise 5 billion Aussie dollars in its Australian bond offering. So tapping the Australian markets. We know they've done that in the UK, other jurisdictions as well, as an example of a company that does not have that free cash flow anymore and is tapping the bond markets to fund and spend on AI infrastructure. To what extent we have the Anthropic revenue numbers that have come through and been reported as well as they lead up to that IPO. Is the Anthropic IPO a test for the broader markets in terms of how well that is taken How much of a test is that for the sentiment around AI?
I don't think it's a test in terms of the sentiment. The sentiment remains strong. I think what's interesting is the capital allocation, and we saw that a bit with SpaceX as well, is that you do see that shift because you have that reallocation of capital. It's been a really interesting story with semis and AI more broadly. You saw that incredible performance up to the start of July, which was pretty brutal, but then in August so far it started to reset again. And I think a lot of what you're seeing there is this quite extreme volatility in that sector. The volatility that we are seeing in AI names is now more extreme than we saw in the internet names. So the volatility of those names, I think, is what is actually more important in terms of the shape of the market. Again, I think this is where diversification is really important. The other thing with these continued bond issuances, we saw Treasury issuances last week, that's where it also puts pressure on rates because there's a natural kind of a capital expansion in the debt market as well. So I don't think it tests the AI thesis, but it does test the allocation of capital and what that means for portfolio construction. We are talking about that more than we ever needed to before because of what we're seeing in terms of volatility in the AI trade at the moment.
Picking stocks continues to be really hard, though. Do I just buy the index? Are we back to that? Because people keep coming on going, you've just got to pick this, you've got to pick that. But and then I looked at the numbers the other day, and it's just so hard to make money picking stocks at the moment. But as the market gets more as you start to see this volatility emerging in key sectors, is it possible for most portfolio managers to navigate that?
I mean, it is really difficult, but I'm an active investor, so of course I will always believe in the active story. I think what you do have to look at is those areas and those regions that are more naturally inclined to the active side. So again, thinking about China, you're talking there, I think that's something which is really ripe for where you've got those parts of the economy that are very exposed to, or the parts of the stock market, I should say, they're very exposed to the electrification and the exporters. I mean, you said yourself, that is the big driver there. If you're thinking about a global portfolio, I think it is very important to be very balanced, taking opportunities of things like Europe, taking advantage of things like the UK. I think healthcare is also very interesting. Second strongest earnings expectations after technology, and yet valuation-wise doesn't look particularly compelling. So I think it's very binary to think this is index versus active. The building blocks of the way that a portfolio can be constructed are a lot more nuanced than that.
At what point do those yields become an issue, particularly for tech? At what level? At what level is it a red flag? Is it okay, we need to rethink our exposure to tech?
Yeah, so I don't think there's a particularly set area. Actually, I think at the moment the yields are causing more problems for the quality growth part of the market. We've still not really seen a rebound from those names that actually have underperformed for quite a long time. And I think they need the catalyst of lower or kind of more stable rates to really kick there. I think for the AI trade, so much of it is the earnings part of the story that I don't like to kind of keep bringing it back to earnings. I think for the market there, it's the earnings rather than the growth side of things. But I do again think that this point of diversification in portfolios is what is so important, because if you are just pivoting to that one area, you are going to find yourself incredibly exposed and incredibly volatile. So building the robustness, at what level is the exposure too high? It's at the point that you're just seeing these big flips that we saw in up to, as I say, the July. I mean, it's incredible to be starting here in August where we're up already about 10% from that drawdown that was kind of minus 16. So that, to me, I think is what is more important. So, Tom, I don't think there's a set yield in the AI sector. What we need for quality growth is those yields to stabilise in some way.
You described earnings earlier on as remarkable. Like, is this as good as it gets? Like, where does it get better? Margins look extraordinary. How do I get... revenue looks pretty good. Margins are amazing. Bottom line looks... how does that get better from here? And is this as good as it gets? Because if the market is hanging its hat on earnings and earnings expectations, can it get better? I'm wondering what gets the market higher.
Well, the expectation is that they do go higher. I mean, the forecast for 27 are kind of into the 20s. So, and what is driving that is that the feeling that we really are just at the start of this incredible AI cycle and incredible AI story, and the implications of that for margins and margins in other parts of the market. So I do think it has got further to go, but it is going to be a rocky journey to getting there. And again, that's why it's so important that portfolios are constructed utilising other parts of the market, the UK, the European banks, the healthcare stocks, not just being really focused on that one sector, because without that, I think the journey will probably be a little bit too volatile for many investors.
Helen, always great to see you.
Great, thanks, Guy. Thanks, Tom.
Coming to see us. Hello, Jill, BlackRock Fundamental Equities International CIO. Let's take a quick look at how European equities are performing this morning. We're still in the middle of August, so just bear that in mind. But what you've got is a tech trade that looks like it's on the front foot. ASML is higher, Schneider's up as well. Some of the defence names. I think I've seen a contract win this morning for Rheinmetall. But you are seeing some weakness elsewhere. Pharma's down a little bit. LVMH, the luxury sector's a little softer. Nestle's a little softer as well. Let's get back to some of the other stories we're not focusing on that board, but we are focusing on elsewhere. Alex Morgan here with the details.
Good morning, Guy. Yeah, let's start with some of the stocks on the move this morning. SIG Group down around 21%. This is coming at a time when they just announced the appointment of Ann-Kristin Erkens as the new CEO. She'll serve as CFO until a successor is found for that role. They are down around 21%. That's the most since the company's IPO, the company making sort of cartons and containers. So down around 21% on that CEO news this morning. Let's flip it over to the miners. We expected to see a bit of a lift. Oh, sorry, let's start with Argenix here. There we go. Then we'll get to the miners. Don't worry, we'll get copper in. Argenix up around 8% this morning. This is off the back of positive third phase trial news around one of their immunology and treatments, which is out this morning. We're seeing them lifted around about 8% into the green this morning. That's Argenix on the back of that phase 3 trial news. Now let's get to those movers, those miners. Up around, as you can see here, up around 2% this morning, lifted in the green. We're expecting that because of that copper price approaching a record here in London. The overall picture for copper seeing that lifted demand as people look to the future and wondering what the tariff situation could be coming from the White House. Markets still guessing on that front. And finally, let's just turn over to European tech stocks doing well this morning. A strong session in Asia, but of course off the back of that news on Friday about Anthropic's revenue. You're seeing here STMicron, Infineon, ASML all around 2-3% in the green this morning. A positive session then, positive start to the session then for European tech names. So we'll keep an eye on those through the day.
Alex Morgan, thank you. We're going to have more insights and analysis on that copper story as well. Copper rising, as Alex was saying, towards a record high as a global supply crunch intensifies. We'll bring you more details next and the implications. This is Bloomberg. Welcome back to the opening trade. We are 22 minutes into the Monday session. You are seeing that grind higher still for European stocks, just up 0.2%. The DAX over in Germany is unchanged. A little bit of softness over in France. The FTSE 100, though, is getting a bit of a lift from basic resources. That's a top-performing sector right now with gains of a little over 1%, thanks to copper, Guy.
Yeah. We've got enough copper, we just don't have it in the right place. Copper advancing towards a record with a key spread in London widening to extreme levels. There's a sign of competition for supply at the front end. Let's bring in Bloomberg's metals and mining reporter Martin Ritchie. Martin, do we have a shortage of copper, or is it just in the wrong place?
That's a very good question, and it kind of gets to the crux of the matter here. Look, there's a lot of big picture stuff for copper. Mine supply is struggling, demand is growing fast, so that's the kind of broad theme. But there's kind of distortions, I guess you would call them, in the market at the moment. We've had this very unusual situation where everyone's expecting President Donald Trump to put tariffs, import tariffs, on refined copper into the US. Ahead of that, loads of metal from around the world, especially from Asia, has been sucked into the US, huge stockpiles there, leaving the rest of the world's supply slightly barer. And then On top of that, there's a sort of complication this week. The LME, the London Metal Exchange, has a delivery date coming, its monthly delivery date for its futures contracts coming on Wednesday. Now, because there's so little supply around, that puts short position holders in a very tenuous position. They have to pay more to liquidate their positions or deliver metal to the exchange. That's why you're seeing this big flare up in the prompt prices, the short-term prices, and this is symptomatic of a temporary supply squeeze. That spread that we're talking about went above $500. As far as I can see, there's only been 2 days, in the past few decades where that has happened.
Shouldn't this be bullish for companies like BHP? I mean, the stock is up today, Martin. They have their earnings out later today, and yet they're looking at a record low buy ratings. Is that right, ahead of the earnings today?
Yeah, so to put this in context first, all the major miners that have reported so far, have all pointed to copper. You can see how much the higher copper price this year has, boosted their earnings, talking about Rio, Glencore, Anglo, all of those benefiting from higher copper prices, and that's also feeding into the share price. For BHP, they're also benefiting, but one of the issues is they're actually struggling with production as well. So their numbers in terms of production may be falling, and that's one of the big tasks for the relatively new CEO, Brandon Craig, to kind of turn around. And that's one of the reasons why there's that kind of stock caution on BHP.
Okay, Martin, we're going to leave it there. Thank you very much indeed. Martin Ritchie joining us on the copper price. Just another input in terms of the kind of electrification trade that we're watching so carefully, right?
There's a lot of copper that goes into data centres.
Yeah.
Helen Jewell of BlackRock was making the case again that spending is going to continue. It's going to continue to benefit earnings. But of course, there is potentially an inflationary impact of that. We're seeing a relatively benign inflation picture out of the US. But does inflation rear back in 2027? And does that put some of the central banks on the wrong foot?
I don't know. It's so hard to call it. Are we going to get some clarity? The other thing is, are the data good enough at the moment to give us an accurate kind of read? It was interesting hearing that conversation, talking a little bit earlier on about kind of what we're going to get at Jackson Hole, about maybe upping the conversation around that. Do we have... What are our predictive abilities right now if we can't figure out... It's
not just a UK data problem.
No, it's not.
It's also in the US. Coming up, we're going to switch focus. We're going to discuss the rapidly growing market. Well, it ties in, of course, to physical AI with the co-founder of warehouse robotics firm Dexory. So a view there in terms of how the innovation around robotics is changing, what it means for jobs, logistics, and how to scale a business in robotics here in the UK globally. That conversation is coming up. This is Bloomberg. This is the opening trade. Happy Monday. We are 30 minutes into today's session then. So after ending the week a little softer for European stocks today, up 0.2% across the benchmark, cautiously optimistic then. Retail sales data out of the US suggesting that there is less likelihood that the Fed will go with a rate increase in September. That at least is the expectation from many traders out there. And that's part of the sentiment story today. You're flat across the DAX, flat across the CAC current. A little bit more of a brighter picture here in the UK with the FTSE 100 adding 33 points. Copper and basic resources is certainly part of that story. Guy.
OK, let's talk about the volume picture. It is a little light once again. We are in the middle of August, and as a result of which, it appears that maybe trading desks aren't as fully staffed as they normally are. So we're down by 60%. Market's reasonably balanced, 256 up, 327 down. Again, kind of we're drifting sideways, seems to be the narrative. That's at the index level, at the sector level. Dip below the surface, and there's a few interesting things happening. Argenx is out with some positive drug trial data this morning. That stock is getting a benefit from that. So we're seeing some positive stories emerging in the pharma space, up by 7.75. We were talking about this earlier. Turbocharge, I think there's a Berenberg note out on Acceleron. It is up by 9% this morning. The marine industry, particularly part of that narrative. Glencore, we've been talking about what the copper picture looks like. It is up quite nicely. So the copper story certainly helping out London, as Tom was suggesting. On the downside, SIG, new CEO out the door. The market doesn't like that. It is down by 16%. Stena is down by 12%. Again, that's in the industrial space. And Kering in the luxury space, down by 1.12% this morning. The whole space is a little softer this morning. Can I tie that to the weak China data we saw out once again? We also saw weak retail sales data out of the States Friday. Maybe that's a factor into the mix as well. Anyway, it's not just Kering, it's the space, the whole luxury space. Down by 1 to 2%, I would say, probably is where we are this morning, Tom.
OK, here's what else you need to know this morning then. Lebanon has seen its deadliest day of fighting in months after new Israeli strikes killed a total of 11 people, including a senior Hezbollah commander. The fighting threatens the US brokered ceasefire and may further complicate deadlock negotiations between Washington and Iran. The 10-year JGB yield hit the highest level since 1996 on fiscal concerns and speculation that the Bank of Japan may hike in the coming months. Speaking on a TV Tokyo program, a former finance ministry official said the BOJ should raise its benchmark interest rate at every meeting to narrow the rate differential with the US and ease pressure on the yen. And Bloomberg has learned that Anthropic is telling prospective investors its second quarter revenue jumped at least 14-fold versus the same period a year ago. Documents seen by Bloomberg show the Claude chatbot maker reported prelim revenue of more than $11.5 billion. It comes as Anthropic battles rival OpenAI, of course, to win over corporate customers ahead of their potential IPOs. Sticking with AI, a new era of the technology is unfolding, of course. It's physical. AI is being trained to understand the physical world, and that could transform the labour market as we know it. Humanoid robots are being backed by big money, but can the tech really deliver on a potential $200 billion market over the next decade? The head of Europe's Neura Robotics thinks ultimately it can.
If you look at the physical AI space, it's tremendous. So it's like something like even I can't tell what happens in 1 year. I mean, it's ridiculous. It's fast. It's big. So and it's real.
Well, that was David Reger from Neura Robotics. That interview featured on the latest episode of Bloomberg Tech Europe. Let's continue the conversation now and bring in Oana Jinga, co-founder of Dexory. It's a service robotics and AI company based in London, and customers and clients include Maersk, DB Schenker, ID Logistics. You raised, I think, $165 million last year. What is it? What is the gap? What is the solution that you're trying to provide? What is the gap that you're trying to fill, and how much demand are you seeing right now?
Yeah, so I think it's a very interesting kind of topic because everyone focuses now on the actual robots. We're actually focused more on the data that will fill the gap for these robots to actually be able to operate in the physical world. So we're a data intelligence platform for warehousing and logistics. We collect a lot of real-time information from inside the warehouses, and we use that to help our customers, all the ones you mentioned, and also a lot of manufacturers, pharma companies as well, to be a lot more efficient in running their supply chains. And that data, of course, then feeds into all of these other types of robotic companies that we're talking about to be able to help them be efficient in delivering the jobs that they're doing.
What kind of efficiencies are we talking about? How significant is this? And what is the competition in this space? Because you're not the only players trying to use the data that we find in warehouses to try and find those efficiencies.
Yeah, so I'll actually start on that because, interestingly enough, we're quite unique in what we do because we do use actually autonomous robots to collect that data. So for us, the robots are just there to capture information, digitize the space. Things like stock level of kind of available racking space, for instance, understanding how people move around, how forklifts move around. So every kind of, even if a second per hour kind of delivers at the end of the day quite a lot of extra efficiency, and you can actually deliver a lot more with less resources. So yeah, we're quite unique in that way because our robots are 18 meters tall. They scan
18 meters
tall. Yeah, the world's tallest autonomous robots designed specifically to capture data inside warehouses.
How automated are warehouses right now?
Yeah, it's everyone kind of thinks about this one kind of YouTube video where they've seen lights out warehouses and so on, but that's probably 0.001% of the market. Right. The entire market is still very much kind of a combination of manual, some robotics, and of course a lot of existing machineries like forklifts, because that kind of gives our customers and the world a lot of flexibility in terms of the goods that they can bring in or out or how much volume they're dealing with.
So when you fit out a warehouse, you are obviously spending a lot of money. Is that the challenge? Is that the biggest kind of challenge at the moment? That I don't know how long I'm going to use the shed for. I don't know how much. When people fit out, are they looking for maximum flexibility or maximum efficiency?
So that's obviously the biggest debate, right, is how do you balance the two? Because you could invest a lot in automation, but taking 10 to 20 years to recover the cost, of course, is not very feasible, especially in today's day and age where margins are so low when it comes to supply chains. So I think it's kind of finding that right balance that our customers are dealing with a lot. And that's where we come in because, again, constantly monitoring how things are doing then enables them to also kind of make sure that everything that they have in operates with the maximum efficiency.
When I speak to people in the robotics space, they often make the case, look, we are faced with labour shortages, particularly in sectors like warehousing, and we've seen that for a period of time. And so it's about addressing that problem. But there is presumably a future where the AI, the software and the hardware becomes so effective and so efficient that they are replacing significant numbers of jobs beyond those that are being replaced right now. What does that picture look like?
I think it's still quite far away. And it goes back to that flexibility that we were talking about earlier, because the more you automate, I mean, especially in today's day and age where that automation is not fully flexible to really be able to operate in any kind of world scenario, you still kind of limit what exactly the type of goods that you can have in that particular warehouse or the workflows or even the routes that kind of these robots are taking. So it kind of limits you to a certain type of infrastructure. The moment you have to change that, let's say, for example, a DHL changes a customer from a pharma company to a grocer, that is a completely different model for them. So that would mean, again, a complete change in the type of machinery and automation they're using. So automatically that will be a very, very big cost again. So
is the objective to build robots that can serve multiple sectors? How easy is it to build a robot that does an Amazon warehouse versus a pharma warehouse? How feasible is that at the moment? And is that the kind of the end goal that you're moving towards?
And I think a lot of the companies working on humanoid robots, that's exactly what they're betting on, is having this general purpose robotics platform that can deal with anything from your house to obviously the warehousing or like the manufacturing sectors as well.
I don't want an 18-meter robot in my house. That's going to be a
You
struggle.
would have a very big house and a very nice house, probably.
Is the focus on humanoids, is it a distraction? Is there too much hype around humanoids and not enough focus on the kind of robots that you produce?
It's a great question. I think for now, yes, because, again, going to that ultimate goal where you have that one platform that can do everything, it's going to take a very long time. Whereas in the meantime, for instance, the warehouse hasn't been really built for humans. It's been built for forklifts. So you don't really need legs or arms necessarily to move around. So like a very good platform on wheels can deliver maximum kind of like output without needed a human form.
So what's the best format for a robot if it's not humanoid? Is it basically just a very clever forklift?
It's a great question. I think I always go back to the kitchen environment, right? Like you have a dishwasher and a fridge, and like the best format for a robot would be whatever its purpose is and being designed around that purpose.
Okay. Oana, there's a lot more questions we have.
I know, I've got loads.
I can tell you, guys ready with a whole lot of additional questions and how to get robots into his house, mainly to do the
smaller
washing
ones.
Maybe not 18 metres high. And maybe that's something you'll work on. Oana Jinga, co-founder of Dexory, thank you very much indeed. UK-based robotics company, of course. You can dive deeper into our robotics coverage in the latest episode of Bloomberg Tech Europe. You can watch that on the Bloomberg Terminal and, of course, on the Video Hub and on YouTube.
We've got a bit of news coming out on Commerzbank. So remember, we've got the ongoing saga within the European banking space. UniCredit's looking to take over Commerzbank. Looks like they're getting traction with that. The German government, story on the Bloomberg right now, may be looking, if that were to be the case and UniCredit does gain traction, maybe looking for some sort of a stake in that bank. So that's an extra little wrinkle that we now have to consider.
Stock largely unchanged right now. Coming up, we are going to get back to what's happening in terms of the oil flow. Oil fluctuating after fighting in Lebanon intensifies and attacks on shipping in the Strait of Hormuz continue. Details are next. This is Bloomberg.
Welcome back. You're watching the opening trade. We are 44 minutes into the session and we're not going anywhere in a hurry. The copper trade is lifting some of the London miners. Elsewhere, we're seeing a little bit of weakness in the luxury space. That may be impacted by the Chinese data, plus also the data we saw out of the United States Friday. But we are mid-August and volume is quite low.
And we're mid-August, and the climate continues, of course, to pose challenges, and we're seeing that across the continent. But both specifically right now in what is happening in Belgium, a wildfire in Belgium destroying about 2,700 hectares of nature reserve and forcing about 600 residents to evacuate in an area near the border with Germany. Local media says it is the largest in the nation's history. Let's get more from Bloomberg Chief Europe correspondent Oliver Crook, who's standing by with the details. Ollie, what is being done to contain the fire? Is there any success on that front? How damaging has this been so far?
Yeah, so Tom, I mean, we're getting record after record in all these sort of different climate metrics that we've been talking about over the last couple of weeks. And there's here another sad metrics for the Belgians, which is the biggest wildfire in their modern history. As you say, they're burning almost 3,000 hectares. That's almost 7,000 acres of territory. The sort of good and bad news here is that the bad news, obviously, it's in a forest. It's in a nature reserve, so it continued to burn. The good news is that it's so far been away from a lot of human structures, so it hasn't caused that much destruction to sort of human infrastructure. But as you say, hundreds of people have been evacuated. We have an update this morning that the German army has come over, also is helping. There have been German firefighters that have been involved with this fire since it sort of took root on Friday, and it is not yet under control. The good news is that there has been some rainfall in the eastern part of Belgium. This is, of course, a fire that is moving slightly further and further towards Germany, so this is a major concern that is going to affect the Germans as well. And there's a town that's been partially evacuated. There has been a little bit of rain, but again, from the authorities thus far, it has not been enough to contain the fire. So they're going to continue to fight the fire. It's been a couple hours now that the sun has been up, and they've been sort of active in that quest. But of course, this is a story not just in Belgium. There are wildfires in France, in the UK, in Spain, in Greece, all over the place at the moment. This is a story that is obviously not going away with every passing year.
I guess you could probably think of as a sort of forest as animal infrastructure. Not human infrastructure, but animal infrastructure. Yeah. Ollie, you're now our river warden, so what's going on?
Yeah, so listen, there are two rivers that we're keeping a close eye on. Obviously, we were focused last week on the Rhine. We are focused this week on the Danube because we have now got this situation here in Hungary where there is the major nuclear power plant, the Pax nuclear power plant, just south of Budapest, that really generates 40% of the nation's electricity. The problem that power plant has had, as so many nuclear power plants in recent years, is that there is not enough water in the river to draw up the water and cool down the reactors, which is how you sort of generate the electricity. So it's been running at a fourth of its capacity thus far. There was a concern that there would be so little water that they'd have to shut it down completely, which again would take away 40% of Hungary's, the entire country's energy supply. So what they have now done is sunk two enormous barges, 80 meters long, into the river in order to bring up the water level. That is a temporary measure as they sort of build underwater infrastructure to sort of deepen the basin from which they can draw. But again, this is the story we're getting left, right, and center for the nuclear power plant, but of course for the passage of ships. I'm looking now at that Rhine River level that we were watching last week, the Kaub River level, which, as you guys will recall, as we were talking last week, we were at 10 centimeters on the water level. That was a record low. We are now today, this morning, at 5 or 6 centimeters. So we're getting yet another record. So these are the issues we're going to be dealing with across Europe. And of course, it is going to refract through the political establishment. We've already had conversations about obviously generating electricity, doing it in a more climate-friendly way. But more and more, there's going to be a political debate about adaptation. And I'll give you just one recent example. Now, apparently, Marine Le Pen officially is the presidential candidate in France for air conditioning.
Air conditioning. Yep. How's that going to gain traction? We'll wait and watch with interest. Ollie, didn't expect that one. Thank you very much indeed. Oliver Crook joining us on the latest when it comes to the weather and the environment. I'm going to switch gear. Iran's foreign ministry spokesman, speaking just a few moments ago, I just want to update you on this, said the 60-day deadline for the expiry of the Iran-US MOU, quote, has lost all relevance because US violations have meant that negotiations for a more permanent deal never really began. He added that discussions between Iran and Oman to reopen the Strait of Hormuz are continuing, though. Let's get the latest on this. Bloomberg's Middle East energy reporter, Anthony DePaola, joins us now. We're getting further escalation in Lebanon. We're watching events in the Strait of Hormuz. Tied all together, where are we this morning? It feels like we're moving away from a peace deal rather than towards one.
Good morning, Guy. Yeah, for sure. If there's any talks, these are the ones that are going on behind the scenes. Things like Oman and Iran discussing Hormuz. Of course, we heard over the last few weeks various times the U.S. administration saying we're close to a deal, but we haven't seen anything. As you said, the MOU, which expires today, the MOU and that ceasefire expires today, but both countries have already declared that dead on arrival, and so we're not expecting any major change because of that expiry there. But of course, continued fighting in the region, be it in Lebanon, be it strikes on vessels, are continuing to heighten concern around the situation in the Gulf. There's always the potential for escalation. We have continued to see vessels struck in and around the Strait of Hormuz as they try to get out and get some of that oil to the market. So that's what's of major concern for the oil markets. And so that's why we're seeing prices remain elevated. We're still around that $90 a barrel level after a big gain last week. So we are staying up there as we continue to see attacks. ADNOC over the weekend saying that they had more than 20 vessels struck, and we saw one towards the end of last week as well, which continues to highlight the perils and the dangers about those exports.
Okay, so those vessels are still being struck, Anthony, and yet there is some suggestion, there is some reporting as well from our own team that maybe more oil is actually getting through the strait than some had expected.
Yeah, for sure. We're looking at numbers that could be around the 4 million or even higher of barrels per day that are going through Hormuz on vessels. And these are vessels that are sneaking through under the cover of darkness, and also, to use the jargon of the industry, going dark, meaning they're turning off their satellite transponders so they can't be tracked using the satellites to go through without being seen by Iran, often with military escorts as well to protect them. So those vessels are going through, taking those needed barrels to the market. They're doing what's called shuttle runs, where these vessels are loading inside the Gulf, often vessels that are either owned by the state oil companies or chartered by them, or some of the traders that are willing to go in. They're loading inside the Gulf, taking barrels outside, and then doing a ship-to-ship transfer in the Gulf of Oman, either off the coast of the UAE, the eastern coast of the UAE, or off the coast of Oman. And those vessels are then going on to the final destination. So that's really helping ease the pressure in the market. And so that's why we're at around $90 as opposed to 100 or more. So that's getting some barrels that are needed into the market. The U.S. Energy Secretary had said this month that they were seeing even as much as 9 million barrels a day going through Hormuz, which a lot of people in the market said seemed on the high side, and we're surprised about that. So we're seeing numbers that are a little bit lower, and that's mainly from producers like ADNOC in the UAE, which has been pushing a lot of its vessels through Hormuz. Some others have been slower to pick up on that, Saudi Aramco, for example, because they've been able to rely on exports through the Red Sea. Countries like Iraq and Kuwait are completely dependent on Hormuz and trying to push those barrels through. But we're still not back to a normal situation, but it is continuing to help the market, Tom and Guy.
Okay. Anthony, thank you for that important update out of the region. Anthony De Paola in Dubai. Let's look ahead to what else we are watching throughout the week. Later today, ECB Chief Economist Philip Lane will join a panel on Europe's defence build-up. Tomorrow, Germany's ZEW survey. Wednesday, UK CPI, UK inflation plus Fed minutes. And on Thursday, the Riksbank rate decision, which will break for you, and earnings from Alibaba, Walmart as well, stateside. And on Friday, global flash PMIs.
So more data to fold into this narrative around the idea that the Fed maybe backs off hiking rates this year. That certainly is how the market is pricing things right now. You had the image print Friday, you got retail sales Friday, you had the inflation data that we were watching as well so carefully last week. Oana Conningham, editor for Markets Today, the newsletter this morning, joining us around the table. Good morning.
Morning.
All of that comes together to point the dollar lower, right?
Yeah, absolutely. We've seen quite a bit of weakness in the gauge of the dollar recently, and I think that retail sales data, as well as some weaker consumer confidence from the US, is weighing on the US currency. And that in itself then has, there are beneficiaries of that as well. So we've seen other currencies stronger across the board, actually, every major peer, as well as bond yields, falling as while we've also got things like precious metals, gold benefiting from that weaker dollar and potentially weaker interest rate environment as traders do pair their bets on expectations of a hike from the Fed.
Yeah, the Bloomberg Dollar Index right now down almost 0.3%, so that's not a small move for that index. You talk about the impacts across some of the commodities, some of the metals. Copper, of course, is one of the headline stories for us today at those close to those record highs. And part of that is a tariff distortion, arguably, but this is significant in terms of the moves we've seen higher in copper.
Yeah, so we are heading for a fresh record again, and there's some interesting spreads in London which are quite indicative of a real rally taking place. That is obviously beneficiary to miners, so a lot of UK listed companies this morning doing quite well on the FTSE 100, but it's also something which we're seeing across other base metals as well. So we have that affecting mining stocks, but it's also really about those supply dynamics. And, you know, we're also lifting precious metals as well. We are seeing metals stronger across the board, though that's probably more of a dollar effect. And all of those things do tend to work inversely too.
In terms of the UK data later this week, is it going to inform us in terms of where we're going to go next with the BOE? Or are we just all waiting for the budget now? Is that the kind of the big narrative that kind of overarches everything?
Well, we have a little way to go before the budget.
Yeah.
I think, you know, we're going to be looking at inflation. We've still got a few earnings coming through. We've got public finances as well, which I think could be quite interesting, particularly given we've sort of had a new Prime Minister since we last heard. So there is quite a lot that we will be watching. We do have some sort of retail data as well. So we're looking to see how the summer's played out and how the oil price, rise in July is still something we're really seeing coming through.
Yep. Well, great to see you. Thank you very much indeed for stopping by to see us. Wane Cunningham joining us, updating us on the week ahead. Monday's done, reasonably quiet, but I think it ramps up towards the end of the week. Anyway, from Tom and from me, that wraps things up. Lizzie Burden is in charge of the Pulse. She will be up next. This is Bloomberg.